Here are 10 mistakes that traders consistently make that you can fix right now to massively improve your performance. Number 1 is ignoring market structure. So in a trade like this, you see the market starting to flip to the downside. You see the strength behind this downward move, and you start to look for a short, whether that's from an area of resistance or whether you are using supply or demand or whatever concept it may be. You start to see the market shifting down. You think this is a very strong trade, so you look to sell from one of these points. Let's say you're doing what I do and you are using supply and demand to trade. You want to look for a sell like this. But the problem is, what actually happens is the market drives all the way up and takes your stop out. And that's because you didn't consider the market structure. When we zoom out and take a look at what this market is doing, we can see it is very clearly consistently making higher highs and higher lows. So if we sell into this, it doesn't matter how weak the market looks when we're zoomed in like this, we are basically trading against the trend. The trend is up, and if we sell into this, we are at very high risk of just being stopped out while the trend continues. So make sure you are always considering the market structure, that's the highs and the lows, whether a market is trending up or down. Mistake number 2 is not considering high time frame context. So this trade, we have a market that is moving down, it's very clear. It might look like something we want to sell into. So we could have a position like this, selling from the supply zone, looking to take this market lower. But after we get into the trade, we get a big drive to the upside and a pretty major reversal. So obviously, in hindsight, buys would have been the good move. Now, if we were to zoom out here and consider some of the bigger picture context, we would see that what the market has just done is react from a demand zone, a pretty significant demand zone over here on the higher timeframes. With this extra context, we can see that this trade is actually a bad position because we are selling against demand. We're selling against an area that is very likely to create a market reversal. So make sure you've got high time frame context, zoom out, look at the higher time frames and scale down with top-down analysis. That's going to save you from getting into bad trades and easily avoidable losses like this one. Mistake number 3 is so simple, but it's ever so common, and that is not using a stop loss. Now, when we get into a trade, we should always have a predefined target. So if we wanted to sell here, we should have our target down towards wherever we want that to be. But we should also always have, and instantly, as soon as we take the trade, a stop loss, okay? This is going to limit our risk if the market flips on us. Now, sometimes traders get into a trade and they don't place a stop loss, whether that's because they think the market couldn't possibly go higher, whether it's this false idea that it's got to reverse so it doesn't matter if it gets up here, or whether it's simply because you've placed the trade on and you've said, I'll come back in 5 minutes once I've had a drink and I'll put my stop on. Now, regardless of what the reason is, not putting a stop loss on your trade is very dangerous because the market can do this and it can just continually move against you. It doesn't matter how strong your bias is and how much you think the market has to go down, it can always do the opposite. And if you take a trade without a stop, it can easily flip on you and wipe out your entire account. So whatever the reason, make sure you've got a stop loss as soon as you take a position. Mistake number 4 is chasing price action, chasing the markets instead of waiting for better entries. So in a trade like this, we see this market falling with a lot of strength, especially the past few candles. This can lead you to believe the market is going to continue moving down, which can be right, but it can then lead you to chase the market. You might get into a trade down here thinking if I get in here, at least I'm going to catch the rest of the move because what I really don't want to do is miss this trade. Or you could go even riskier with a stop loss somewhere in the range, thinking because the market is pushing so strong, it must continue pushing at this speed again. Now, the problem with this is the market is generally always going to come back and react from more meaningful levels before it makes its larger moves. So if you chase the markets and jump in after these large moves have taken place, you're actually getting subpar entries where your risk reward is going to be terrible, or you are upping the risk massively by putting your stop in a dangerous zone. What's better to do in an example like this is to just wait for the market to return to a high interest area, such as this supply zone, and you would place your sell from there. And will you miss some trades? Yes, you will. But will you also avoid lots of terrible losses? And will you also get better risk reward and higher returns on the trades that you do manage to take? Yes, you will as well. So don't chase the market, don't get FOMO, don't rush to follow price action after these large moves. Instead, identify the high probability pullback regions like areas of supply and demand and use those to take high quality trades. Trading mistake number 5 is holding trades through major news. This is a trade that looks solid. We have a supply zone to sell from, we've had a break of structure, we can expect quite happily for the market to trade lower. However, what we actually see is after we get filled into our trade, there is a massive spike, a big wick either way, which stops you out of the trade, even though the trade was generally good. This was caused by economic news, specifically the non-farm payroll, which happens on the first Friday of every month. What economic news does is creates a speculative spike where institutional traders are placing trades either side of the market, whether they expect the market to go higher or lower. And the short-term confusion driven by the news creates these massive wicks, which can stop you out of even the best trade. So make sure you're not holding trades through news. Avoiding news is simple. You can use a calendar like fxstreet.com, go to the economic calendar, and you will have a list of all of the news and when it's coming out. We don't really need to worry too much about the yellow and orange news, but this red folder news where you see this red box, you want to avoid trading through that on the specific asset. So for example, there is red folder news for the euro. Make sure at this time on this day, you are not holding any trades on the euro because you will be prone to getting spiked out like what we just discussed. Mistake number 6 is trading too big. If you get into a trade with a very large lot size, bigger than your account can handle, thinking if this works out, it's going to hit a home run trade, well, there's 2 risks to this. Number 1 is the trade loses and you end up taking a massive catastrophic loss that eats a lot of your account. But number 2, the other mistake and the more common one is if the trade runs into drawdown a little bit, which by the way is completely normal for a trade, you might end up closing the trade down here in a panic that it's going to get worse. Every time the market pushes a little bit into drawdown, you might be worrying and looking to get out of that position because you now have lost faith in the trade, simply because you don't have confidence due to how much you've risked. That can lead you to get out of trades early before they end up making the proper move, which means you've actually taken a loss even though the trade worked out. If you just used a reasonable risk percentage instead, you could have profited from the trade because you wouldn't have hesitated to hold it once you were in. So when you size too big, you open the doors to big losses, but you're also swayed by emotions and end up messing up good positions. Mistake number 7 is risking random amounts on each trade. So if you take a trade like this and it makes $4,000, this feels good in the moment. But if your risk is all over the place and you risk more on your next trade, well, you might lose $5,000. In which case, trading can start off by looking well if you hit a streak of winners. But with random risk and no control over how much money you win or lose on each trade, trading will eventually look like this, where your winning streak will come to an end and those massive losses will take over and drive you into a deep drawdown and a lot of sadness. So what you should do instead is risk a set percentage on every single trade you take. Doesn't matter how confident you feel about the position, that is not an excuse to size up. I would say choose 1% risk per trade and stick to that on every position you take. That's going to keep your losses controlled and allow your risk reward edge to play out. So stop risking random amounts on trades, stick to 1% per trade. Mistake number 8 is trading through rollover. Now, rollover is a time of day and something that happens. Around 10 p.m. UK time to 11 p.m. UK time, there is something we call a spread rollover or a spread widening. It's where brokers roll over the day's price action and basically the spread, the difference between where you get into a trade and the current market price, will widen massively. Now, if you've ever taken a trade and it looked completely fine and the market didn't even reach your stop loss, but for some reason you got stopped out and you couldn't work out why, that's because of rollover. The market chart doesn't even need to get down to your stop loss for you to take a loss on a trade. The same goes for short positions. It's like a sneaky trap that forces losses on really good positions. So the best thing you can do to avoid this scenario, and now you know if it's ever happened to you why,